Chapter 5, Merchandise Operations and the Multi-Step Income Statement. Now, the study objectives here. Identify the differences between a service company and a merchandise company. Explain how we record the purchases for a merchandise company under the perpetual inventory system. Explain how we record sales under a perpetual inventory system. And then distinguish between a single step and multi-step income statement. Determine the cost of goods sold under the periodic statement. All right, a merchandise operation. A merchandise company buys in the inventory that it sells. Think of Carrefour here. Office Depot, Home Depot, Walmart. These are all companies. They don't produce goods. They buy it from the producer. They bring it into their store. They put it on a hanger and they put on a price tag and they sell it. They don't change it in any way. And their sales revenue is just known as sales. Now, when we measure how well or the income statement for a merchandise company, we must deduct from the sales revenue the cost of the goods that they did sell. So they bought something for 60 dirhams and they sold it for 100. So sales revenue would be 100, the cost of goods sold would be 60, and the difference we call gross profit, and that would be 40. From the gross profit, then, we subtract all operating expenses to get us the net income. Now, the operating cycle for a service company, we perform the service on account, then we collect the money, and that's it. For a merchandise company, though, we have to take cash, we have to buy in inventory, then put it on our shelf, which we call merchandise inventory. Then we sell the inventory, and then we collect the cash. So inventory is the difference between a merchandise company and a service company. Now the flow of cost then, the cost of goods sold is the beginning inventory plus the cost that I purchased minus the ending inventory gives me the cost of goods sold. Now there are two types of inventory system. There's perpetual inventory and a periodic. We're going to focus on the perpetual inventory system. You'll be happy to know it's a lot simpler. We will talk about the periodic, but that will be towards the end of this. Now, in a perpetual system, what we do is we retain or maintain a record on each item we have in inventory. And therefore, at all times, we know exactly what's in inventory. And when we sell it, we just deduct it from inventory and charge it to the cost of goods sold. Now, if you're in Carrefour, you know that everything that you buy out of there has a barcode on it. Well, that's because Carrefour is on a perpetual inventory system. That barcode tells them exactly how much they paid for that inventory. In a periodic system, we have so much inventory, we don't have a barcode for everything. So we can't keep records that way. So the way we calculate, we know what we started off beginning inventory. We add what we bought during the year. That tells us exactly how much we had available to be sold to the customers. And then at the end of the year, we count what we have left unsold. And the difference is the cost of the goods that we did sell. That's the periodic system. The perpetual system is what's used in high, like car dealerships or television stores. They all have serial numbers, so they know exactly how much they paid for the items they are selling you. Okay, now, how do I record these purchases? Well, I have one account called merchandise inventory. And when I get the invoice, when I purchase, I get an invoice from the person I purchased from, and it tells me I purchased 3,800. So therefore, let's say we use the purchase invoice, prepare the journal entry for this. Well, I have a new account called inventory, and that account is for everything that I purchased that I'm going to resell. And I debit that 3,800 because it's an asset account and it goes up on the debit side. And I'm going to pay for it later, so it's accounts payable, credit 3,800. Now, if I had to pay for the freight cost to bring that inventory into my business, then I have to add that freight cost to the price of the goods. Now, some suppliers pay the freight cost for you. If the seller pays the freight cost, that's called FOB destination. That means the seller sold you the goods and um, hold on. Okay. Um, so terms of sale, free on board. Okay, now let's illustrate it. Assume upon delivery of goods, May 6, Silk Stereo pays haul it freight 150 freight charges. Well, that's added to inventory 150 and credit cash. Now, if we're talking freight out, if we're looking at it from the supplier's point of view, he charges freight out 150 cash, but we're talking about the merchandise company. So we're talking about here inventory. Now, sometimes people return their goods or they want an allowance because they're not satisfied with the goods. So we don't return or we don't reduce that we take accounts payable and we give them back the inventory. Okay. Sometimes they want a discount, credit terms. And if you pay, sometimes we give credit terms for 30 days, but if you pay within 10 days, you take a 2% discount. And 30 means you get no discount after 30. So 110 EOM means one discount is paid within the first 10 days of next month. NO10 means new net amount due within the first day of next month. Okay, assume the stereo pays the balance due 3,500. Remember the gross invoice price was 3,800 less purchase returns and allowances of 300. So they owe them 3,500 on May 14th, the last day of the discount period. To prepare the journal entry then, accounts payable, I'm going to pay them off, so I reduce what I owe them by 3,500. Inventory, I take a 2% discount on that 3,500 and I pay the balance, 3,430. So I paid 3,430, but I canceled my accounts payable of 3,500 because I took a $70 discount. So I reduced my inventory by that amount. If we fail to take the discount, then the journal entry would be debit accounts payable 3,500, credit cash 3,500. Purchase discounts of 2% on 3,500 is $70 for 10 days. Now that's quite a big savings. Okay. So in summary, then my inventory account, when I purchased, it's debited 3,500. When I pay the freight in, it's added to the cost of my inventory. If I return goods, I reduce that amount. If I take a discount, I reduce that amount. So for that transaction, all of that inventory was 3,280. That's what it cost me. Now, on the other side, let's record the sales. Sales are recorded when earned. That's when we have sold the goods to the buyer. We have an invoice that says we sold. So now what we have to do is record the fact that we sold. But we have two journal entries here. One, we recognize the sale. This is the sale. Credit revenue, as I always do, and debit cash or accounts receivable. But now I have to reduce my inventory and recognize that I have a cost of goods sold. So therefore, I reduce the inventory by the value of the goods that I sold, and I debit the cost of goods sold. Let's look at an entry. Let's assume Supply records its May 4th sale of 3,800 to Silk Stereo on account. Assume the merchandise that they sold for 3,800 cost them 2,400. So first of all, the sales. Accounts receivable, debit 3,800, credit sales 3,800. Now take it out of inventory and recognize the cost of goods sold. So debit the cost of goods sold for what we paid for that item that we sold, 2,400, and take it out of inventory. So every time you have a sales for a merchandise company, you have two journal entries. One, recognize the sale, and two, take it out of inventory and recognize the cost of goods sold. Now, the sales returns and allowance. Sometimes they will return it for us. Well, when they do that, we don't reduce sales. We set up a separate account. So prepare the entry would make the return goods of 300, and the selling price was 300. We paid 140 for it. So now we have to say, okay, sales returns and allowance, debit 300. This is a contra revenue account, and credit accounts receivable 300. Now we put it back into inventory, 140, and we reduce the cost of goods sold. So that's how we record that. Now, what about defective? Same thing, put it back. Now, what if they take a sales discount? Well, we promote quick payment. What we do is we set up a separate account called sales discounts. And as soon as SOC Stereo pays the balance due 3,500, which is the 38 minus the 300, and the last day of the discount period. Well, they're going to accounts receivable has been canceled because we received the money. They took a sales discount of 70, and we got cash at 3,430. So that's how we record um, the receiving of cash within a discount period. Now, income statement presentation, there's a single step format, which is this, and that is simply revenues minus expenses. This is what we learned in the first chapter. However, for a merchandise company, what we do is a multi-step, because what we want to do is highlight the gross profit, the income from operations, and net income. And this is how a multi-step income statement would look like. It's sales, net sales, minus the cost of goods sold gives me gross profit. Now, from gross profit, I subtract operating expenses like selling and rent and administrative costs and salaries and things like that. I get income from operation. Now, there's another category. Sometimes businesses earn other revenues and have other expenses. We show that separately so that we can always judge how well a company is doing on operations and not have the net income or not consider income after all of this stuff. But this is what's called the multi-step income statement. Now, sales revenue then is determined by sales revenue less sales returns and allowances, less sales discounts, which makes it net sales. Okay, then the cost of goods sold gives me the gross profit. Operating expenses are then deducted, which are salary and wages, utilities, advertising, depreciation, freight out, insurance, which gives me income from operations of 30,000. Now, sometimes there are other non-operating activities, such as interest revenue, dividend revenue, and rent revenue, and interest expense, and loss on sale, and loss on strikes, and things like that that had nothing to do with operations. We put that in a separate category down here, other revenues and other expenses, and then we show the net income, or income before income taxes and then income taxes. And that's it. Thank you very much.